Good morning and good afternoon, everyone. Welcome to our final webinar before the summer holidays. My name is Olga, and I'm joined today by Matthew Donovan, our Head of Rig Market Research, and Sofia Forestieri, our SVP Offshore. For those of you who weren't able to attend our Esgian Private Breakfast during the IADC World Drilling Conference in Estoril, Portugal, we are pleased to bring today's session to a wider audience. Today's webinar is titled Offshore in Transition, Power Contracts and Volatility. During the session, Matthew and Sofia will explore who's driving offshore demand today, why contracts matter more than ever, geopolitics and market structure, and implications for rig value. We encourage you to submit questions throughout the presentation using the Q&A function, and we'll dedicate time at the end of the session to address as many questions as possible. Please also note that the recording of today's webinar will be shared with all registered attendees later this week. And with that, I will hand over to Matthew and Sofia.
Thank you very much, Olga, and thank you to everybody for joining us today for our webinar, Offshore in Transition, Power, Contracts and Volatility. Again, I'm Matthew Donovan, Head of Rig Market Research at Esgian, and joining me for this presentation is Sofia Forestieri, our Senior Vice President for Offshore. Moving on to our agenda today, we're taking a look at our market outlook for 2026. Then we're going to see who is driving this offshore demand before taking a closer look at the jackup market and the floating rig markets. Sofia will take you through consolidation and fleet scale and rig values and the path to a durable upcycle. Then we will finish with key takeaways from the presentation. Beginning first with near-term rig outlook, where we see resilient demand and rising supply risk. Global rig demand and utilization have declined in recent months due to the conflict in the Middle East, and the long-term effects of this conflict on commodity prices are uncertain. Competitive utilization, which had been stable at around 80 to 82% from mid-2025 to early Q2 2026, has now dropped to the mid-70s. In the Middle East, Saudi Aramco had been putting units on suspension, while some jackups in other countries have been released early. But outside the Middle East, rig demand has remained resilient, with an uptick in interest for rigs to work in Southeast Asia and other regions in response to the oil and gas supply issues caused by the conflict. Now, the terms of a long-term peace deal are uncertain, but jackups have begun returning to work in the Middle East. We are expecting most suspended jackups in the region to return to work by 2027, with some additional demand in the region likely as global oil inventories will need to be replenished. In the floating rig market, recent fixtures in Brazil and other key areas have stabilized future demand, including demand for harsh environment semi-submersibles. We've seen new requirements in recent months for continued floating rig demand in India, West Africa, and Southeast Asia. And drilling contractors are seeing renewed interest from operators for exploration projects globally. Due to these factors, we are expecting global rig demand to rise from 2026 into 2027, with long-term contracts in both the jackup and floating rig markets contributing to demand remaining stable with high utilization over the next several years. And with few new build units entering the market and a reduced number of cold stack rigs that are candidates for reactivation, supply in some market segments is likely to be tight going forward. Moving now to Sofia for this slide.
Thank you, Matthew, and hi, everyone. Good morning and good afternoon. Here on this slide, we are taking a look again into our long-term demand for both supply and demand. In terms of offshore drilling, we have done this exercise for a few years now, and what we see and what we know by now is that offshore rig demand is not a question anymore. Now the question is mostly how the uncertainties that we've seen in the last few months, maybe even in the last year, they will reshape this market tightness that we expect. So when we look at the chart to the left, we're looking at competitive rig supply forecast for the three rig types that we have. And what we see is that supply is expected to stay slightly stable to declining through the next 2 decades. and that is already taking into account potential reactivations of cold stacked rigs and even stranded rigs in shipyards. And when we look at that supply together with the chart on top on the right, which is our rig demand forecast, considering the OPEC technology-driven oil demand scenario, we see that there is an expectation, as mentioned, to continue a very healthy rig demand, not only for this decade, but for the next 2 decades. And when we compare that rig demand with the supply, we see that we do expect a very, very tight supply coming forward. And that is confirmed by the utilization reaching above 90, expected to reach above 90%. And when we look at this scenario for the next 20 years, a question starts to arise, which is maybe it is time to reopen the non-new build conversation past 2035, especially when we're talking about jackups. We've been saying for a few years now that there is no room for new orders as well as for reactivations, and that is totally in line with where the market is today. But again, looking at long-term demand and always taking into consideration energy security, we see that maybe this chapter should start to be discussed, should start to be reopened, and the possibilities should start to be evaluated. Now, moving into this long-term demand and now looking at who is actually driving that demand, on this slide, we are going to cover super majors versus NOCs and how this power imbalance now has changed throughout the years. What we see, what we have here on the charts on the top is the backlog added per year, as well as the total backlog accumulated throughout the years for both the NOCs and the super majors. And what we see today is that today's offshore drilling demand is increasingly NOC-led, with activity more and more concentrated in a small number of heavyweight regions, while super majors remain important, but they're being more selective, more diversified geographically, and less dominant in setting total market demand. And we can see from the numbers that NOCs, they not only carry today's backlog, but also the future demand in offshore drilling. When we look at the charts in the bottom, we now address the question of why super majors may have lost relative demand power. And the analysis that we conducted here, we used the CapEx allocation from the super major group, and we saw since the COVID years how that CapEx allocation and the company's strategy changed or switched from oil and gas to renewables, either continuing away or back and forth, as we've seen for some companies. And what we've noticed, especially when we look at this total backlog correlation with oil and gas tilt chart, we see that some super majors, they may have become less hydrocarbon focused, and with that, they had less backlog awarded throughout the time period that we're using here. One example would be Total Energies. Also, when we look at other cases such as BP, for example, or Eni, where there was a more diversified switch back and forth in terms of oil and gas and renewables, and also a step back in terms of BP, for example, towards oil and gas strategy, we see that this the backlog, it's not only influenced by original mix, but also LNG exposure, legacy backlog, project timing, so when FIDs and startups are supposed to happen, and not just, this CapEx allocation. Also, something that we're seeing more and more when it comes to the super majors is that there's a lot of capital discipline that is not only announced a lot, but is also discussed a lot. And with that capital discipline has come, shorter contract awards or spot 1 well, 2 well contracts. And that, of course, reduces also the pool of backlog. And on the other hand, we've seen from the NOC side that they remain very much anchored in hydrocarbon development, and of course, awarding longer contracts as well as a higher number of contracts. Now, with that, with this new balance or imbalance that we see in the market, how does the NOC dominance is reshaping offshore activity and exposure? On the first chart that we have on the top, we see that the NOCs, which are in yellow, they have a much larger fleet impact. They are not, as expected already, exposed to a lot of the different regions in the country, but they are in key regions and in a large number. And when we look at the super majors, we see that it's the contrary. They have a much global spread, but less number of rigs in operation in those regions. What does this mean for offshore drilling activity? Well, it means that we're more likely dependent on NOC spending cycles. We more and more are going to see backlog concentrated in those key regions. And also we will see a larger influence from the Middle East, from the Far East, India, and South America, which are, as we can see from the chart, NOC heavy regions. Now, where does the super majors remain heavy? Well, they remain quite important in selected international deep water, ultra deep water regions, in frontier projects, as well as technically complex scenarios. And as we can see from the chart on the bottom, is just another way to visualize how much, how big is the difference between the NOCs and the super majors. And when it comes to this fleet size, we can see that the NOCs, they were 6 times higher than the super majors in terms of fleet size, or as well as in terms of backlog. Total backlog 7 times in 2020, 9 times in 2025. And in terms of adding backlog, in terms of contracting activity, they keep being around 4 times higher in activity than we see compared to the super majors. And then to sum up this section, what is then the hidden risk behind this? What we see is that offshore demand is stronger but narrower. So more and more offshore drilling demand is concentrated in NOC-led programs. And those NOC-led programs, they also narrow down the regional exposure for offshore drilling operations. What this supports? This supports activity, of course, the healthy demand that we saw in the beginning of this presentation, but also raises reliance on fewer customers and regions. And one recent example that we have seen where this hidden risk becomes clear is that one NOC decision can move the market, as for example we saw 2 years ago, Aramco's jackup suspensions, which has started focus in the Middle East and ended up reverberating through the entire global jackup market. And with that, I hand it over to you, Matt.
Thank you very much, Sophia. Now we're going to take a little closer look at the jackup market, where demand is expected to recover after some of this near-term Middle East disruption. We're expecting an upturn in jackup demand after the recent slowdowns due to the conflict in the Middle East. Competitive utilization for the jackup market globally is expected to return to above 80% in the second half of 2026 and continue increasing over 2027. Globally, we're seeing demand for jackups stabilized by multi-year contracts in multiple regions. The Middle East remains vital to the market, but we're also seeing multi-year charters for rigs in West Africa, Southeast Asia, and India. And this long-term backlog helps insulate the jackup market from some commodity price fluctuations, particularly with many jackups working on brownfield work subject to lower break-even prices. The precise timing for Middle East recovery is still uncertain, as the no lasting peace deal for the region has been confirmed, but we do expect demand rising from 2026 to 27 as rigs return to work in Saudi Arabia and Qatar and operators seek to replenish diminished reserves globally. So in Saudi Arabia, we already have seen some of the units that were suspended due to the conflict in the region returning to work, as well as units that were earlier suspended during Saudi Aramco's previous suspension program, starting to return to work in the region. Now, in tandem with this, we are seeing increased jackup demand in Southeast Asia as operators seek to boost local exploration and production due to the global supply disruptions. So within Southeast Asia, we have seen an uptick in interest for jackups, and we've seen some longer-term contracts fixed and expected continued high demand in key areas to keep up with local demand for oil and gas. In another key region for the global jackup market, demand in Mexico is still currently constrained by the financial issues of Pemex, but drilling contractors in the region do see long-term work needed to maintain production levels in the country. So we do expect some longer-term contracts for their fixed in the coming years. Moving now to floating rig market, where we expect to see utilization tightening into 2027. Demand and utilization of floating rigs are projected to rise over the coming year, with competitive utilization potentially reaching the mid-90s in 2027. This is following significant contracting activity over the past several months, with the drillship market tightening. More fixtures for 27 and 28 are expected over the next several months. Discussions over some of this work predates 2026. So these are a lot of work that was previously pushed forward into these years or has been subject to long negotiation periods. We are expecting fixtures for that over the rest of this year, not firming up the picture for 2027. We see several units rolling off contract globally in the near term that have already secured work for 2027 or are indeed in these advanced discussions for upcoming work. After the recent blend and extend contracting program from Petrobras, demand in South America remains steady, with long-term work in Brazil and also continued work in Guyana and Suriname. The outlook in the US Gulf has been flat recently due to a combination of long-term contracts and slow demand for additional short-term spot work. So moving forward, some recent and ongoing tenders are expected to result in new fixtures in West Africa, Southeast Asia, and India, drawing some of the excess capacity from the Americas to these regions. As we sort of mentioned previously, there are a very limited number of new build drill ships or cold stack units that could rejoin the drill ship market. So not much in the way of additional supply that could join in the near term. There are some units that could be reactivated, but reactivation does take quite some time for these rigs. There's very little near-term availability in the harsh environment semi-submersible market, with most units working through 2027, and indeed with recent fixtures with Equinor have additionally tightened the harsh environment semi-market into the early 2030s. Demand is slower for sixth-generation semi-submersibles in more benign environments, but that has also been boosted recently by long-term contracting in South America and some upcoming activity in West Africa and Asia Pacific. Moving now to day rates, where we see room for floating rig day rates to rise and still some uncertainty in the jackup market. We've seen recent jackup day rates kept relatively flat in recent months due to the uncertainty in major markets, particularly in the Middle East and Mexico. But rising demand for jackups next year sets the stage for day rates to begin increasing in 2027 as units return to work in the Middle East and activity picks up in other key areas. Premium jackups are now in demand in most major regions, and day rate improvements will be seen more in this market segment, while the oversupply of standard units keeps rates flatter in this category over the next couple of years. For the floating rig market, as the drillship market tightens and utilization remains high, there are likely opportunities for currently available drillships to reprice at higher day rate levels in 2027 and 2028. And based on the recent Petrobras blend and extend contracts and several other recent fixtures, drillship day rates have recently remained within these previously established day rate ranges this year, and due to some near-term availability and long negotiation periods, some fixtures over the next several months will likely follow this pattern. And then again, we will see some repricing at higher levels next year. Day rates are expected to remain highest for 7th generation units, with the potential for some improved rates for 6th generation drillships and standard semi-submersibles as activity moves downwards into these categories. Harsh environment semi-submersibles have little near-term availability, with much of the fleet on long-term contracts and options, keeping day rates in this category stable to slightly increasing. And again, as we mentioned, rig reactivation. Any rig reactivations will likely require upfront payments and day rates and contract length that justify the expense of bringing these rigs back into the market. And turning now to Sophia to discuss consolidation in the offshore rig market.
Thank you, Matt. So yes, this slide, we're going to focus on the consolidation trend that we've seen, as well as rig values. And a big question that we have today is consolidation. Is it a reaction to volatility or a prerequisite for survival? Here at Esgian rig values, we have been conducting this analysis about the top 5 drilling contractors in each segment, so jackups and floaters. And one thing that we have seen since we started, which was in January 2025, is that that top 5 has changed quite a lot in a year and a half. And from when we presented this slide 2 weeks ago in Portugal, it has changed again with recent M&A and rig transactions that have been announced. When we look at the top chart on the left, we're looking at the top 5 jackup owners. And here we have, of course, all of this is assuming all of the announced M&A and transactions they actually go through. So if they do, we would be seeing the top 1 drilling contractor in terms of fleet size continue to be ADES, but now ADES Saipem, after they announced recently that they were acquiring Saipem's Middle Eastern operations, and that includes some of the Peronero jackups, and that's what we see the number there, and that will be followed by ADNOC Drilling, Borr, Castle, and Transocean, the new entity Transocean Volatility. And one thing that stands out when we look at this group is that out of all of the competitive jackups, just those 5 companies, they will be taking over 205 rigs, and that is close to 40% of the entire global jackup market. Now, when we move to the right, we look at the top 5 floater owners, and here we have Transocean Volatility, followed by Noble, and then by big difference in fleet size, we then see the other top 3, which are Seadrill, Castle, and Constellation. And what we see again, that those 5 companies, they will own around 86 competitive rigs. And again, more and more we are seeing consolidation in the market. And when it comes to the question, volatility prerequisite for survival or reaction to volatility, when we see M&As between smaller companies, like for example, the also recently announced Eldorado Drilling and Vantage Drilling, we see that maybe the answer is leaning towards a prerequisite for survival in a world where more and more companies are merging and getting larger and larger fleets. Then when we move into looking at the valuation of those top 5 for the jackups, we have the ADES Saipem jackup fleet on top, and then we have Borr, ADNOC, Castle, and Transocean Volatility. And the interesting thing about this chart is Borr Drilling as the top 2. So Borr is a company that has been acquiring several rigs in the last year, going from 24 competitive jackups now to 34 competitive jackups, and we see that the in placing itself on top 3, but we see when it comes to valuation, its fleet valuation is above 3 billion and very close to the valuation of ADES's fleet, and that goes to show the strategy the board is implementing in terms of acquiring premium rigs and having a premium heavy fleet as well. Now, when we look at the top 5 floaters, it is another very interesting group that we see here. We will have the Transocean Volatility floater fleet on top by far with over with a fleet valuation over 11 billion, and then followed by Noble, Seadrill, Castle, and Constellation. And the thing that stands out here is our top 5, as mentioned, we've done it by fleet price. However, if we were to do it by fleet value, we would have Odfjell Drilling be a part of the top 5, and not only the top 5, but being in the top 4 position. And that is even though the company only has 5 harsh environment NCS capable rigs, its fleet valuation is over $2 billion. Now, when we look at where rig values are today and where they're going, what we see, and when we look at all of the three charts in the left, is that recovery has been underway since the beginning of the year. When it comes to the premium jackup average rig value, even though there is the conflict and the uncertainty in the Middle East, we still see that recovery happening. So the recovery started in early January and it continues to happen even with the conflict. And what is expected is just that recovery will be slower than what previously estimated, but it will continue to happen. As we can see, we're very close to the numbers of a year ago. And when we look at the floater side, we see that not only the drill ships are on par of what we had a year ago, the NCS, not the NCS, but the harsh environment semi-subs, they actually are recovering and are beyond the what the values were a year ago. When it comes to rig values forecast, we do expect the next few months, as well as waiting to mid 2027, to be flat with a slight increase, with peak for the different rig types towards mid 2029 and continue flat in that level. And that goes to show that we do expect the market to continue to recover and to improve and continue on this long-term rig demand that we've seen from the beginning of the presentation. And then again, this just shows that when something happens in the market, it first affects the demand, then the day rates, and then lastly affects the rig value. So rig values are in many ways very resilient, even with all of the ongoing volatility that we see in the market. And now we come to our key takeaways of today. And what we have is that disciplined supply and long-term demand are improving the offshore backdrop, and this backdrop is increasingly led by NOCs. Near-term volatility remains and is expected to continue for some time, but tight rig supply should keep utilization high and support day rates into 2027. Also, fleet scale is becoming the key advantage as consolidation increases and value shifts to larger rig owners. The next phase looks less like a rebound and more like a durable upcycle. Thank you very much, and now back to you, Olga, for Q&A.
Thank you, Sophia. Thank you, Matthew, for a very insightful presentation. And once again, thank you for everyone who has joined us today. If you'd like to learn more about Esgian Rig Analytics and Esgian Rig Values, or discuss how our solutions can support your business, please don't hesitate to reach out to us. We again appreciate your time and participation. And now let's move on to a couple of questions that we have. The first one is, where do you see leading floater day rates coming from in the short term?
So generally when you see, thank you, Olga, thank you for that question. Generally when we see sort of a kind of breakthrough rates from previous, from sort of previously established ranges, it's usually for short-term work in sort of regions where there may not be a large number of rigs anyway. So, while you might see some sort of high spot rates in particular parts of Asia Pacific, Africa, South America, places where there aren't a usual group of rigs that are doing work, and for sort of short-term 1 to 2 well jobs, usually that's where we would see kind of breakthrough rates on those. So, frontier wells in regions that don't have a sort of standing supply of units that are meeting that demand. Generally where we would see sort of those spot rates through. So that's where you see sort of the possibility of available units repricing at those slightly higher levels. And of course, with a lot of the long-term capacity tied up already, you can see higher day rates for longer term work as we move into next year.
Fantastic. Thank you, Matthew. The second question is around supply and demand forecast. Do you believe, given your supply demand forecast, that reactivations or new builds may happen before we have been forecasting?
That's a great question. And I mean, I think there's definitely if we look at continued high utilization, that does sort of set the stage for reactivations of units that were sort of previously cold stacked to meet that demand. I think what we're seeing is probably we're at the point where if you have to consider a reactivation, it's going to have to be for quite long-term work, and there's going to have to be upfront payments from, the operator to bring for a drilling contractor to realistically bring a long-term stacked unit back in. But, we are seeing rigs that have been idle for some time, getting fixed to new contracts now. So I think that will, inevitably at a certain point, there's some units that are going to be candidates for reactivation over the next few years.
Thank you, Matthew, for answering and for giving us a little bit more insights. As we reach the end of the webinar, we would like to thank you once again for everyone who has joined us today. Should you have any further questions about today's presentation, the offshore market, or Esgian's products and services, please feel free to get in touch with our team. And on behalf of everyone at Esgian, we wish you a wonderful summer, and we look forward to connecting with you again. Thank you and have a great day.
Thank you, everybody.
Thank you very much. Bye-bye.